Can you buy a house with a ton of student loan debt? The answer is yes, but you just have to make sure that you don't shoot yourself in the foot by not having a plan at all. So let me give you an example from a reader that reached out to us from our student loan planner website. So this reader was not qualifying for a mortgage, and she was a dentist, and she had refinanced her student loans to a 7-year plan. So she had to pay about $6,000 or $7,000 a month, and her income was only about $150,000. And to be honest, they never should have approved her for that refinance in the first place. But what happened is she decided to maybe cut her hours and work a little bit less, and then so suddenly she had this giant monthly payment, and she was barely able to afford childcare, and she didn't have enough money left over to buy a house. So the first rule of thumb for trying to buy a house when you have a bunch of student loan debt is don't refinance into an extremely aggressive repayment term when you're trying to qualify for a mortgage. In general, we suggest that people hold on to an income-driven repayment option like revised pay-as-you-earn while they're trying to qualify for that mortgage, and once that mortgage is locked in, then you could feel free to refinance to a very aggressive repayment term. The second thing to think about is you can refinance, you can go ahead and get lower interest rates, but it might be a good idea to take advantage of something called the student loan refinancing ladder, as we've termed it. What that means is that you can start off with a 20-year term. For example, let's pretend you have $100,000 of federal student loans and you refinance to a 10-year term, your payment would be $1,000 a month. That means that the bank might be a little worried that you're going to pay them back if you have already a $1,000 a month obligation that's speaking for some of your wages. Instead, you could refinance to maybe a 20-year loan term and only have $600 to $700 a month that you have to pay. That lower cash flow might not seem like a big deal, but to a bank who's trying to make a mortgage to somebody who may or may not have a super long credit history, that could make the difference between qualifying for the home of your dreams and not. The third thing that we consider, that you really should want to consider as a student loan borrower is that you want to try to buy a house less than 2 times your joint income. As a student loan borrower, if you try to reach and try to qualify for the maximum home price that you possibly can buy, you're setting yourself up for some unfortunate circumstances. I think that it's really not a good idea to buy at the very top end of what you can afford unless you want to put yourself in a situation where you never are able to retire. So if you can simply avoid refinancing to a really aggressive repayment term, stick to an income-based program to keep your payment low and until you have your mortgage in place and limit your purchase price for your house, then you're going to be in great shape for qualifying for a mortgage. The other thing that I would warn you of is old underwriting guidelines specify that a bank has to take into account 1% of your student loan balance and presume that that is your monthly payment that you have to pay every month. So for somebody with a very large student loan balance, say a veterinarian with $300,000 of student loan debt, the bank is going to look at that debt and say that this person has to pay $3,000 a month. A bank's typical rules of thumb will only allow about 40-ish% of your income to go to debt overall. So if you're making $100,000 a year as a veterinarian and you have a $3,000 payment that's spoken for your student loans based off of the bank's underwriting rules, then already 40% of your income almost is going to student debt, and then there's nothing left over to go towards a mortgage payment, so the bank would deny you. Now, the thing that you need to do if you have gotten denied for a mortgage because of being a student loan borrower is that you need to cast a wider net and apply to more places. So, for example, you could apply to banks that are more familiar with student loan borrowers. A lot of banks have doctor loan programs that are more aware of how student loans work, and the new underwriting guidelines that recently came out from the government mortgage companies specify that banks should look at what your required payment is under IBR, pay-as-you-earn or revised pay-as-you-earn, and not 1% of your total student loan balance, which is the way they used to do it. The only exception is if you're in forbearance. If you're in forbearance, then the bank will look at 1% of your student loan balance as your required payment. So in a lot of cases, deferment or forbearance will cause your mortgage application to be denied. If you have any questions, we would love for you to reach out, studentloanplanner.com/help. We specialize in helping figure people's lives out for them if they have a lot of student loan debt, so if that's you, feel free to hit us up. But know that you can achieve the home purchase of your dreams. You just have to be willing to do a little legwork and do the research.